Coming up today, stocks jump after a blowout jobs report. Did Jay Powell make a huge mistake? All the reactions across the financial community. Bond yields have their biggest gain in 2 years. Why Jeffrey Gundlach's concerned with the hamburger helper ad. Oil continues to push higher. What's next for the Middle East? The latest on the Bitcoin creator. And TIGR Brokers continues its monster rip higher. It's been a great week, guys. Let's go. And a warm welcome back, everybody, to the only daily market show where your host actually trades, puts his money where his mouth is, and keeps a transparent track record for all his members to see. We don't just try and sound smart by hiding behind fancy BS. We're focused on making money around here, and making money we have been this week. My stock picks account just closed at a brand new all-time high, thanks to a few key positions in Chinese stocks, which continued to rip higher this week. We also just had a silver miner that we owned get approached with a takeout offer today. In addition to the price of silver breaking out to a brand new 10-year high. In addition to that, our positions in Palantir continue to move higher, now up over 64% since I first gave it out in June. However, what's absolutely stolen the show this week and is actually the best performing Chinese stock, benefiting from all this stimulus coming out of Beijing, is that of TIGR Brokers, officially listed as Up Fintech Holding. You could kind of think of them as the Robin Hood for Southeast Asia. They already got over 2 million client accounts, and that has likely gone up a lot in the last couple of weeks. A lot of Chinese are coming back to their stock market. Their government's literally lending money to hedge funds and companies to buy stock. Not to mention traders all around the region and the world coming back to trading Chinese stocks, and they're doing so with brokers like TIGR, who still only have a market cap of $1.5 billion. Not unreasonable to think one of the biggest online brokers in the world coming out of Southeast Asia could have a market cap, who knows, 10, 20 billion, maybe 50, 100 billion within 10 years from now. We see brokers in the States can be worth that much. And so the volumes coming into this stock are just absolutely incredible. 77 million shares traded today, rocketing up another 34%. Past $12 a share. It's almost $1 billion worth of stock traded today. And when I first mentioned it to you guys in a dedicated video back in late April, some days it wasn't even doing $2 million worth of trading volume. And so it looks like my initial bullish thesis that I gave out on that video is playing out. I was forecasting massive stimulus from China as we had some indications they were trying to turn the tide on things. And that, in addition to how beaten down the stock had been, there were some technical signs of accumulation. But what really stuck out for me in that period of time, just like I showed in the video back then, was its valuation. Just looking over here as I hover over each candle, just looking at a 3-day chart, you can see my stock fair value had it at $8 while the stock was trading down in the low threes. And just like I said back then, it was significantly undervalued. Also had positive shareholder yield. For those of you who don't know, shareholder yield's a modern day take on dividend yield. Not only looks at dividend yield, but buyback yield. That is how much the company's reducing or increasing their float, and also how much they're increasing or decreasing their debt as a percentage of market cap. Business quality score was good. Stock crash risk was low. And so the fundamentals were turning good. The valuation was cheap. And now less than 6 months later, it's up already 250%. And so like I said, we're just riding the trends now. Just looking at my trend candles indicators gone green. And like I said, with a market cap of $1.5 billion, no reason it can't get back into the 30s at some point over the next year or two. And who knows, even break out to new all-time highs. Because like I said, a market cap of 10, 20 billion is not all that far-fetched for an online broker and wealth manager coming out of Southeast Asia that's highly leveraged to the Chinese market. And so if you'd like to get all 28 of my custom TradingView indicators that I show you on these charts every day, including links to all my chart layouts, so you can have all these exact same charts and all these indicators, all my technical ones, all my new ones, all these ones you see here every day. If you want to get access to them all, then click the link below this video and head on over to my website, clickcapital.io, because for the next week only, I'm offering 50% off a yearly plan to my indicators. Just use coupon code TIGR. That's the ticker for TIGR Brokers, TIGR. And when you hit the checkout page, just click on add promotion code and enter in TIGR. Hit apply, and you'll only pay $295 a year. That gives you access to all of my custom indicators, video tutorials, a monthly technical analysis newsletter, and for most people, just one extra winning trade will easily cover the cost of my indicators, which I've spent thousands of hours over the last 8 years developing. And like I said, they were key and me finding stocks like TIGR Brokers significantly undervalued, which is just simply not possible if you're still using the basic free ones out there that most people do. So if you're interested in learning more about my indicators, you can watch a video on this page along with descriptions for each indicator. Portfolio monitor, both technical, fundamental, and market indicators, and these work on all assets around the world. No matter where you are, they don't just work on American stocks. Whether you're in Canada, United Kingdom, Europe, Portugal, Spain, Singapore, Australia, they work on stocks all around the world to give you technical and fundamental insights you just won't see anywhere else. So if you're interested in taking advantage of that, head on over to clickcapital.io and use coupon code TIGR to save 50% off a yearly plan. All right, getting back in the daily market review. Stick with me today. I'm going to talk about this monster move in bond yields and how we just conveniently got a really great jobs report, blowing past expectations. 254,000 new jobs created apparently versus 140 expected. Unemployment rate actually came down 4.1%. And I'll also get you up to date on the Middle East situation, what's happening in the oil market, along with a few other commodities and some other insights into market internals and structure, so you understand exactly what all the market trends are. But first off, let's get stuck into the headline of the day and what really got markets moving. Apparently US hiring accelerated in September, giving further indication that this soft landing setup could continue. Amount of jobs created in September, almost double what economists were forecast. And there's a look at a one-year bar chart of non-farm payroll. See, we had been weak the last few months. Market was really worried about recession risk. However, that seems to have subsided a lot today. Some now saying the recession's been cancelled. However, it's still too early to make those claims. There's a look at the 3-year chart. Still haven't put in a higher high from earlier in the year. So we can't say the jobs market back into uptrend mode. We can just say for the here and now, it's showing some signs of stabilizing. However, this is just one monthly print, also at a curious time, so it could still be noise, and there's still a bit of work to do before the moving average starts curling back up in job growth. However, it did pretty much erase all possibility that we're going to get another big 50 basis point cut. Only up until a week ago, the market was actually giving more odds that we're going to get another big cut than not. Yesterday, it was about 35% chance, and today, market's done a massive repricing, pretty much guaranteeing we get 25 basis point cut, giving no odds of a big cut. However, that didn't seem to upset the stock market. Once again, digested it pretty well. Saw that big dip buy earlier in the week after Jay hinted at the same thing. And here we are pretty much sitting at all-time highs with the Russell 2000 doing better than the SP today as well, up 1.4%. So it's quite funny, isn't it? The Fed's got 500 PhD economists, all the data in the world, talking directly with multiple departments, got all the inside information you and I don't have. Pretty sure Jay Powell knew what was around the corner for the jobs market. However, his justification for a 50 basis point cut was the jobs market was soft, and that was the whole justification for getting ultra dovish right in front of a federal election. However, some investors are starting to question this big rate cut from the Fed. After not only this blowout jobs report today, but just the economic data of late showing things holding up quite well. Although mixed across the board, got that expansion in the services sector yesterday, prices holding up, and we're getting some interesting commentary from across the financial community. With one guy saying today, do we really believe payrolls beat expectations by 70% a month before the election? We just had an 800,000 Bureau of Labor Statistics revision, in which they told us a month and a half ago they overstated the US job growth by 30%. Also just heard from Peter Schiff, today's jobs report is the second to last one that will be released prior to the election. I don't think it's a coincidence that it came out much stronger than expected. My guess is that voters won't get the real numbers until after their ballots have been cast. And so like we've been said, there's quite a few coincidences and convenient timing of a number of things happening at the moment. The ultra loose Fed and Treasury being one of them. Peter went on to say that, according to the household survey, 86% of the jobs created in September were government jobs. Without the seasonal adjustment, 100% were government jobs. How convenient. These are non-productive jobs that are paid for either by taxes or inflation. Also heard from Zero Hedge, said a record 785,000 government workers were added in September, pushing total government workers to a new record high. And that's something we've also seen in this administration as well. Not only a blowout in spending and debt, but also in government workers. We heard from another investor today, it's the greatest economy, 4.2 trillion in new debt spending inside of 18 months can buy. Another one saying, Powell says he has to do jumbo 50 basis point cut because the labour market is cooling. Labour market just added 250,000 jobs. Another one, Jay Powell's so powerful, he just saved the labour market with a single 50 basis point cut and caused bond yields to rise during a rate cutting cycle. He's a Chuck Norris of Fed presidents. Stanley Druckenmiller this morning. I hope the Fed is not trapped by forward guidance the way they were in 2021. GDP above trend, corporate profits strong, equities all-time high, credit very tight, gold new high. Where's the restriction? Mohamed Al-Aran, taken at face value. This is a blowout US jobs report. Impressive job creation. On a standalone basis, this implies not just a solid but a strong labour market, continued US economic exceptionalism. Good reason for the Fed to push back more against the markets, forcing it into the single mandate, maximum employment policy box, as they seem to have forgotten about inflation for now. An ex-secretary of the Treasury, Larry Summers, today's employment report confirms suspicions that we are in a high neutral rate environment where responsible monetary policy requires caution and rate cutting. With the benefit of hindsight, the 50 basis point cut in September was a mistake, though not one of great consequence. And looks like the bond market certainly agrees with a bit of all that. Huge rip up in yields today. And if you've been watching this daily market review, that's what I was letting you guys know. that I was seeing happening as well. After we had that bullish divergence on the DSI, plenty of bullish seasonality, we look to have broken this parabolic downtrend after a small little base. Same deal on the 10-year, pushing back up, getting towards 4% now. Calls on TLT to fall again, also helping to bump the dollar up as we're looking for a retracement to that 103, 104 level. And once again, the market is pricing in higher expectation for inflation going forward now. And so like I said, if we don't get a recession, as crazy as it sounds, we may have already seen the low in 2-year yield. And of course they could retest, come back, keep forming a base. However, if things hold up and maybe get too good, spending goes back up, so does inflation. Well, then 392 is pretty cheap on the 2-year. Maybe why we've seen Stanley Druckenmiller actually short bonds in size. Because the only real way it's going to go below 3 is if we do get a recession. Even if inflation does keep coming down, the Fed will probably just meet the 2-year in the middle, somewhere around 4. And so given the exploding US debt, record spending, likely to keep tailwind for inflation, that's bullish for bond yields. And US debt just keeps screaming higher, kind of mind-blowing to watch. Now approaching 36 trillion. I remember when I started this channel early last year, it just crossed 32 trillion. Now we're on our way to 36 trillion. And so even though the port strike was mysteriously negotiated away quickly behind closed doors, conveniently pushed forward to literally the same week a new president is set to take power in January next year. Got an interesting post today from this guy here. The longshoremen getting 8% per year raises over the next 6 years sounds like a lot until we realize the US federal debt has risen 8.3% per year, compounded annual growth rate since 2007. With US government spending rising 8% a year, if you're not getting 8% a year in raises, you're falling behind on a real basis. And that's true. And this is not just for the States, this is for any country in the world. If your government is increasing their spending by 8% a year, it's pretty hard for inflation in actual terms, not just the numbers we're fed, but what we're actually paying on the ground, to not be too far behind that. And so if your job or your business or your investments, if they're not going up by at least that, then you're falling behind in real terms. Because that's kind of the number one goal of investing, is to grow your wealth at a faster clip than inflation. Because if you don't, your purchasing power decreases, and thus by extension, your standard of living. You're on a path to zero. So that sets the bar really high for all of us to keep up with inflation when you've got a government spending out the wazoo. And like one of the best economists of all time, whose thoughts and work and words actually align with data, Milton Friedman says, history shows that over a long period of time, government will spend whatever the tax system raises, plus as much more as it can get away with. And it's so true. Remember, the government doesn't create wealth. They just take wealth from us and spend it, and often do a really bad job at it. And that's why, like Milton Friedman, I always argue for a smaller government. There should only be a couple of umpires on the field for 100 players, not 20 or more. Milton also put it eloquently when he said inflation is taxation without legislation. Again, so true. And actually a guy who used to run the country, Ronald Reagan. We don't have inflation because the people are living too well. We have inflation because the government is living too well. So long story short, this pace of spending is just simply unsustainable. Unfortunately, it affects the bottom half of income earners disproportionately to the rest of society. It's actually of net benefit to the top 1% as everything gets inflated, including property and stocks. But also we've seen this time and time again throughout history over thousands of years. It's not the first time it's ever happened. And it pretty much just demolishes the value of a currency when you have so much of it. And so as investors, want to keep mindful of that. Ideally want to spread your wealth out across multiple currencies and assets all around the world, along with some exposure to commodities and other things that are priced in the dollar. But just getting back to the stock market, and it looks like that AI chip trade is still alive. We aren't breaking out to new highs yet. We did just hear from Nvidia CEO. So demand for his new Blackwell GPUs is insane. And he is a hype master, but he does have the numbers to back up his claim. So Blackwell's in full production. Blackwell is as planned. Everybody wants to have the most and everybody wants to be the first. Apparently he's got billionaires jumping over each other to try and buy as many GPU chips from him as possible. And the stock's certainly holding up. It's been consolidating for a few months now. Earnings still a month and a half away. However, nonetheless, it is a good sign for the market when you've got its leading sector still holding its trend. And now we've got this strong jobs report. Is the Goldilocks economy back? Is this for real? Or was this just a 1-month blip? Or was this a little massaging of the data, as they say, to get the headline the market wants, keep it on a sugar high? Or is the economy really going to escape a recession and the Fed will actually be successful in what they're trying to do and get in front of it? We've got Ed Yardeni predicting the S&P 500 could reach 8,000 by 2030, based on a simple analysis of a historical growth rate. His bullish projection is supported by a roaring 20s scenario in which productivity grows. Earnings per share for the S&P 500 index could double to $400 by the end of the decade in a roaring 20 scenario. And so if the S&P does get up to 8,000 with an EPS of 400, that would imply a price to earnings ratio of 20 times, which is actually below current level. And according to Charles Schwab, the US stock market has never been healthier, as more stocks have outperformed the S&P 500 over the past 3 months than at any time on record. We have been seeing some good signs of market breadth. It was really the Mag 7 that bounced off those late 2020 lows and led 2023 higher. It was a really skinny bull rally. However, this year what we've seen after Q1, in which the Mag 7 just ripped out of the gate, they've kind of pulled back, consolidated, and it's been a broadening of market breadth. Seen small caps tick up, mid caps, and all sectors now trending above their 200-day moving average. And we can see that in my sector trends table indicator, which is largely green across the board, and also my sector breadth table, giving a deeper look underneath the stock market. Two strongest sectors at the moment, financials and energy. Bit of a bounce back in technology the last few weeks. Industrial's doing good. However, that defensive rotation we had seen in the prior few months into staples, healthcare, REITs, that's all pulled back a little bit except utilities. That's why we've been thinking utilities are not just trading on the defensive trade, lower yields, but also the AI trade. In fact, it's the strongest sector when looking at the percentage of stocks above their long-term 200-day moving average, 100%. But for the here and now, right at the front, it's energy. Energy stocks acting the strongest this week. However, not everybody's on board with this bullish theme. The Bond King, Jeffrey Gundlach, says the economy isn't working after seeing a hamburger helper ad. He's the founder of Double Line Capital, and he saw an ad which makes him think the economy isn't doing well. And this is his post on X today. One way to know the economy is not working for middle-class families is hamburger helper making a comeback. Hamburger helper was introduced when I was a kid to stretch half pound of ground beef to feed a family of 5. I just saw a hamburger helper ad. So is hamburger helper a new financial indicator we all need to start watching now? Either way, it's not a good sign to the so-called Bond King. However, just looking at some data of online retail shopping from Bank of America. In the dark blue, 2022. In the dark green, 2023. You can see online sales start ripping up in November, peak out on Cyber Monday, and fall off into Christmas, Boxing Day sales, and then by early New Year, everyone's blowing out their credit cards and hung over. However, just looking at 2024 in the yellow line here, we're actually tracking above the last 2 years for online spending. So even though it's mostly the top 20-30% of income earners and asset owners still have a lot of cash to burn. And we're kind of at a bit of a crossroads with price action in the S&P 500. Just looking back in history. Obviously, if we get a recession, stock market doesn't like that. We'll trade lower when the Fed first starts cutting. However, if we don't get that recession, on average 12 months later, stock market's higher by 20%. And so here we are on the yellow line, just kind of tracking up. Then over the next couple of months, the market will typically see that recession coming, price it in, or it sees a soft landing like the mid-90s and it keeps grinding higher. So if we don't get a big pullback in the next few months, who knows, maybe this month. October typically is a really volatile month, going into federal election, what's going on in the Middle East. There's certainly tail risks out there. Anything can happen at any moment of time. However, if the stock market holds up in Q4, we get that normal Santa Claus rally, we hold up going into early next year, the market may just be tracking on a no recession path. However, there's big differences looking underneath the hood of the US stock market. In fact, the biggest we've ever seen. In the dotted purple line here, the mega cap 8 forward PE, currently just below 29, and that's helping to pull the S&P 500's PE to be a little bit above long-term averages. However, small caps and mid caps, they're still down near the bottom range. PE's around 15, which is not all that expensive, especially if the economy can hold up and they can start growing profits again. Even bigger historical gap between the forward PE ratio of US stocks as a whole and all other stocks around the world, excluding the US, 14 to 22. Never seen a gap quite like it. Has been going on for a decade, and that's why I think the world is full of opportunity. All you'll mostly hear from some of the biggest YouTubers out there, guys that have hundreds of thousands, even millions of subscribers, is just fear, fear, fear. Filling your head with fear all day. So many people are paralyzed. They can't buy and hold anything for longer than a month. First sign of a dip or bad headline. Their favorite YouTuber flips. Next minute they've sold everything at a loss. However, the reality is there's so many great opportunities. There's so many good secular trends. There's good value. And in my opinion, there's a lot of money to be made. You just got to try and position correctly with diversification and have the wind at your back. So my investing strategy for my stock picks account is kind of a combination of global macro to determine positioning, trend following, classic principles of cutting losses and running winners, and factor investing, keeping the characteristics and numbers of my portfolio all looking good. And so if we don't get a recession and government spending keeps going vertical, then there's real risk of inflation coming back. And we've already got oil having a big week, up over 9%. Even though the world's a flush with supply, we got the most heightened geopolitical tensions in the Middle East we've ever seen. In fact, to pretty much say it is already a Middle Eastern war between Iran and Israel, along with their alliances helping each other out. People are already talking about $100 barrel of oil, and this was on the back earlier this week of Iran's attack on Israel, which included 180 ballistic missiles making it the largest strike of its kind in the history of warfare, according to the Wall Street Journal. And just after we heard reports yesterday that the current sitting president said the US was discussing possible Israeli strikes on Iran oil facilities. I don't know whether it's because oil popped or maybe he made a mistake, because he's also just flipped today and is apparently now warning Israel against Iran oil strike. So it's kind of hard to tell who's really running the show at the moment, who's making these most important decisions for basically the world at this point. Getting reports now from the Wall Street Journal. President's been sidelined as Israel is making the decisions here, and they don't appear to be backing down. They're determined to defeat their enemy. They've been picking them off one by one, and they're still deciding how big to go in their response to Iran. Big implications across the world, across key markets, the political balance in the Middle East, what's set up at hand's a new president, and so they are still conducting heavy airstrike, trying to take out all the military proxies around them before they may go big inside Iran, and that would be a real big event. Because Iran's already said it will destroy Israel's entire energy infrastructure, including power plants, refineries, and gas fields, if Israel strikes Iran. We've also got Goldman Sachs saying crude could spike by $20 on an Iran oil shock. And so usually they wait for markets to close on Friday night, just like now as I speak, before they kick things off. If they are going to do something big, that's what would have been the instruction from the States. So like I've been saying, this still has some tail risk, and it could still blow up over there along with the oil price. Hopefully not, but we just got to be prepared for that possible outcome when futures open on Sunday night. And whether that's this Sunday or next Sunday, this could play out over the next couple of weeks. We may just wake up one day to the price of oil above $80 a barrel. But like I said, that won't really filter through to the price consumers paying at the pump until after the election. And most consumers out there are just oblivious to what the actual situation is going on over there. And not due to their own fault, but rather the mainstream media, which has been manipulated to create a narrative that simply doesn't line up with reality. However, markets don't lie, and that's why first and foremost, we always pay attention to the price action. Now just moving on to an interesting story, which I touched on yesterday. Got a few reactions out of you guys. Apparently HBO is coming out with a documentary next week. Big bold claims that they're going to reveal who Satoshi Nakamoto really is, the inventor of Bitcoin, who wrote the Bitcoin paper 2009. It's been speculated on ever since, as the true identity has always been a mystery. And it was kind of funny, I saw some guys on social media actually claiming it's Hunter Biden that's Satoshi Nakamoto, which I'd find very hard to believe. But if so, I guess that would be the big shock to the world that's been claimed with this documentary. Certainly could explain all those international dealings we've been hearing about. And you know what they say, the apple doesn't fall far from the tree. However, just looking at Polymarket, they've already opened up a market on this. Who will HBO documentary identify as Satoshi? Coming in the favorite, Len Sassaman, who apparently has already passed away at age 31, was an American technologist, information privacy advocate, amongst other things. And so if they did make this claim, it would be convenient for someone who's already passed away, as they can no longer verify that. Coming in second, Hal Finney, who also conveniently passed away at a rather early age. He was an American software developer, credited as lead developer on several console games. He was an early Bitcoin contributor and received the first Bitcoin transaction from the currency's creator. So if it's not him, maybe this guy did know who it was. Computer scientist. Coming in third, Adam Back, and this guy appears to still be alive. A British cyberpunk, CEO of Blockstream. He invented Hashcash. So who knows? I'm interested to see whether HBO has some real credible evidence to back up their claims as identifying who created Bitcoin, or is this just going to be a nothing burger, as we quite often see with these things that get hyped up? That wouldn't surprise me either if they come out with some sort of grey area data to back up their claim. Either way, it makes for good entertainment, and we do look to be getting a little bounce in Bitcoin here as well, just touching the 50-day VWAP, back above $62,000 a coin. And looking back in history, typically over the next 1, 2, 3 months, Bitcoin can rise 10% or more from this point of time. However, I'd say a lot how it trades, especially after the 5th of November, depends on who wins the election. And so financial markets always keep it interesting and challenging for us all. Just after this week, start with the port strike, Middle East, jobs report. Next week, we got CPI inflation on Thursday, along with robo-taxi day. So I'm saying it's a make or break moment for Elon Musk. Certainly been hyped up. Expectations are high. Got to convince investors to keep Tesla shares at a premium valuation. And so if they can pull this off, along with other things, Optimus bot, full self-driving, no reason Tesla can't be on its way to $5 trillion in market cap in the coming years. Just a huge addressable market, the ability to have automated taxis, and of course, this is going to take years and years to play out, just like it will with the Optimus bot. But if it keeps investors excited, they can keep pricing in that rosy future. JP Morgan just raised its price target for Tesla, but still expects a 48% crash in the stock, which is a very specific number they think the stock is going to fall by. Said Tesla's positioned to not grow full-year vehicle deliveries for the first time in its history, and they have slowed down their growth over the last year or two. High interest rates, along with a flood of cheap EVs coming out of China, has taken its toll on Tesla. However, Tesla is more than just an electric vehicle company. I think of them as the world's #1 brand and leader in clean energy. And just like Apple, they can slap their logo on any new product and people will buy it. If Tesla comes out with a smartphone or an X phone, especially if it comes with Starlink, I for one will definitely be switching over. And this is in addition to their battery storage business, which has been growing leaps and bounds as well. And the market has been warming up to it over the last couple of months, even though as other mega cap tech stocks have pulled back. And so next Thursday is going to be really important. Then later on this month, we get their earnings as well. So this stock will definitely be in play next week. And there's a look at Apple, still consolidating after they released their iPhone 16. Microsoft still trading heavy. Meta ripping up brand new all-time highs, making Mark Zuckerberg the second richest man in the world after Elon Musk now. And there's Amazon, still tracking sideways as it has done for a while. Just looking out to next week, inflation rate month over month expected to come in 0.1%, with core set to still come in at 3.1. It's kind of crazy to think we're still tracking core inflation on a 3 handle, and we had the Fed cut 50 basis points, and still the possibility of another 50 basis point cut. Again, just an incredible environment and backdrop we're currently in. However, there's still risks out there, and I can see that in option market pricing, with VIX representing the price of S&P 500 options, 7.3 points above realized volatility, which has actually been tracking down. Market's only moving at an annualized rate of 11.8%, and we can see gold just slightly consolidating below all-time highs. Things keep blowing up in the Middle East. This could easily keep ripping as well. Otherwise, I think it's getting a little crowded here with the bull, may be liable to further consolidation. However, it was really energy stocks that were the clear winners this week on the back of that. After they had been beaten down for a few months, it's been a big rotation back into them this week on huge volumes as well. And of course, China. We were so stretched after we finished last week on that big bearish candle this week. Thought we may have had a little pullback. Guess I was hoping we would so I could reload. However, it just kept on running. So we'll keep watching Chinese shares next week as well. And no doubt TIGR is going to have a pullback. This is obviously an unsustainable rate, not just going to print these big green candles forever. So no doubt this could have a gap down, consolidation, pullback. But like I said back in April, this wasn't just a swing trade for me. This is more a 2-3 year investment. And long term, I still think it has a lot of potential. And that's a wrap for the daily market review this week, guys. Thanks very much for tuning in. And if anybody wants to get all of my custom indicators and save 50% on a yearly plan, now's the time to do so. Just head on over to clickcapital.io and use coupon code TIGR, and you'll have all my same chart layouts in your TradingView account later on today. Have a great weekend, and I'll see you all next week. Cheers.